Welcome to the Field Guide. I'm your host, Brian Colvert. Today we're going to explore one of life's certainties, taxes. We'll at least get some insight on some questions and help navigate them a little better at least. Today I'm joined with special guest, Henery Ip. He's a CPA and partner at Biggs Coford in Colorado Springs. He holds a master's in taxation and has 18 years of experience in compliance and consulting in tax. He's worked at three of the big four tax firms out there, and we're lucky to have him. Henery, thanks for joining us on the show today.
Well, thank you, Brian. Thank you for having me today.
Absolutely. Well, perfect. Well, I'll kind of dive right into it. One of the big questions I always want to start with is that I've heard, unfortunately, from my CPA that I deal with sometimes, or other people, that they tell me it's a good thing that I have to pay taxes because it means I made money. Is that a true story, or is it that I should have done better planning so I pay less in taxes?
Yeah, I think that's a great starting question, Brian. Quite a few of my clients, uh, kind of worry about taxes, when they call me, and then I always tell them that, look, if paying taxes is your only problem, then your problem is my dream. So, so
I
with
like that.
that,
You got different dreams than me, Henery.
yeah. So with that said, yes, paying tax is definitely, a good problem to have. You know, because obviously when you have a tax problem means most of the time that you're financially doing well, not because you're evading taxes and the IRS come knocking on your door, right? So with that said, now of course the second part is it is important to do tax planning. Okay, so I'm always an advocate of paying a fair share of your taxes, but not overpaying your taxes, because it is not our patriotic duty to overpay our taxes.
I like that. I will agree with you 100% on that one. I guess to that end, obviously, you help your clients quite a bit, it sounds like, with the planning. Would you say, what do you say a CPA adds the most value? Why would someone want to use a CPA or a tax consultant, something like that, instead of trying to do it on their own?
Yeah, so it is important to use a CPA, when you need tax planning and compliance services. And I like to emphasize, planning more than anything else, because sometimes clients kind of have a misconception of, hey, I'm paying a CPA to fill out, a bunch of numbers on a form for me. Now, again, it might be true in certain circumstances, but most of the time, one thing that, people didn't realize is, the importance of tax planning. You know, that means that, before the year end, I always, recommend people to, get in touch with your CPA to kind of go over, any changes that happened throughout the year and see if there's any way that, you can still make a difference before the year end.
Gotcha. No, that makes a ton of sense. That kind of ties into my next question I was going to ask you. Since we are towards the year end, I know there's certain things that have to be funded or do things before that December 31st deadline. What are some of the most important things you would say individuals, business owners need to be looking out for towards the end of the year?
Yeah, sure. So before the end of the year, for any taxpayers, who just don't own their own business, right? It's important that they kind of look at, one is, are you withholding enough taxes through your W-2, right? And again, that kind of circle back to emphasize the point of getting in touch with your CPA to run a tax projection, because normally when you are a W-2 employee, the standard withholding rate is about 20 to 25% through
Oh,
payroll.
okay.
So, what happens then normally, when the time comes April, getting your taxes done, then you have taxpayers telling you, hey, by the way, you owe X amount of taxes plus all these interests and penalties.
Oh
So
no.
we want to avoid that conversation and situation, right? So that's why it's important to, get a tax projection done, make sure that you're withholding enough taxes. And, to the extent that you're not withholding enough taxes, then, you can always go back to your HR and, update your form W-4 to make sure that, to increase your income tax withholding to avoid the
Gotcha.
underpayment interest and penalty. Now,
Right.
and another thing is, you know, which I find important is to kind of look at your retirement plans. So, for business owners who have their own plans, now, of course, they have, more time to make contributions to their retirement plan. However, there's still the employee portion of the contribution that you have to be aware that, the contribution need to be made, latest by December 31st. So,
Right.
for once, uh, who plan to maximize their 401k contribution, make sure that, everything is paid in by December 31st on the employee
Right.
portion.
No, very important. Right. Which I think the employee portion, right. It's 22,500 this year for 401ks
That's
with
correct.
the catch up getting you up to 30 if you're over the age of 50.
That's correct. That's correct.
So perfect. No, all of those are great sound advice, which I love. I guess what another big question I have as far as like deductions, things that people can take. Do you see a lot of people miss deductions that they're eligible for? And I guess what would be some of those?
Well, for the clients who hire our firm to do their taxes, then it's very rare that they miss any deductions. So
Right, right, because they got you.
so with that said, for all seriousness, the most common missed deduction that I've seen in the past is, for taxpayers who lived in the non-income tax states, such as Nevada, Texas, Florida. They didn't realize that, even though that they have no state income tax, they can still account for the sales tax that they paid,
Oh,
on purchases throughout the year. Now, of course, there's a standard method to calculate the sales tax of how much you can deduct, which, if that's the method you use, then your audit risk is fairly low. Or if you made significant purchases, in the year, you want to add up your receipts and deduct that amount. But, now uh, the the tax deduction, that sales tax deduction, um, is included part of the overall tax deduction on the Schedule A of the tax return. So imagine that, sales tax, real estate tax, personal property tax all together cannot be over $10,000 since the tax law change from back in 2017.
gotcha. But you're saying like the sales tax that people incur throughout the year, they're able to write some of that off in those states, is what I'm hearing
Correct.
from you.
Correct.
It's
So
faint.
for the ones who live in non-income tax states, they can uh, deduct sales tax they paid throughout the year.
All right. Well, I guess more of a reason to move to some of those states, I guess.
Sure, but personally, I rather pay a little bit, state income tax to live in the beautiful state of Colorado.
There you go. It is
Yeah.
gorgeous. I love it. Well, a quick question for us. So on the Roth conversions, right? A lot of people end up having large 401ks or they have large IRAs and they haven't paid taxes on those. And so Roth conversions tend to be something that I end up having a lot of conversations with clients on as far as, is it a good idea? When should I do it? How does it work? What's kind of been your take on it? Because obviously Roth conversions don't have an income limit. So a lot of these people with these large IRAs or 401ks were making enough income that they weren't able to contribute to a Roth anymore. But now they have this opportunity, they could roll some funds over. What's kind of your take on that?
Yeah, I definitely think Roth conversion is a great idea, but that needs to be done strategically. And the reason I say that strategically is because personally, I don't like create unnecessary taxable income. Right now, again, from a big picture standpoint, the whole purpose of a Roth conversion is, a lot of taxpayers thinking, hey, by the time that I retire, hopefully with help from your firm, right? That
Right.
they have a bigger net worth, right? So logically thinking, people are anticipating the tax rates at the time that they retire, because they have more money, they can take the money out, their tax rates will be higher than what they're paying now. Therefore, it's a good idea to convert now to avoid the higher tax rates later, right? So that's the big picture, right?
Right.
Now, at the same time is, well, how like what's the effective way to do that, right? So, again, that emphasizes in, the point of going to a CPA and to do some planning, right? Because one is that, so for example, one of my clients, okay, he went through a divorce in 2016. Okay, so he's paying a massive amount of alimony every year. Now, fast forward 3 years later, after divorce, he sold his business and retired. Okay,
Right.
so his ordinary income went down significantly, right? Is almost went down to almost close to zero, right? So
Okay.
with that said, then the income that he's been receiving is mostly tax exempt interest income. Okay,
Oh,
so that
okay.
that's not part of the AGI calculation. Okay, so what happened then, I tell them to look, now is the time for you to convert some of your 401k into a Roth, right? Because, you're able to utilize some of the alimonies that you're paying to offset the income from the Roth conversion. So strategically, every year, we're converting, his 401k, to the extent that, his alimony deductions can absorb those income. So, you know, in effect, he's converting, his Roth conversion, right? His at a point that he's paying no income tax now, and then at a later time when he takes out money, there's still no income tax.
Which that's fantastic.
So so that's why it's important to kind of look at, not just looking at your income level now, but we also have to look at the income level in future years, especially for the ones who thinking that they work hard and then they earn the right to retire early, they earn the opportunity to retire early, right? Then as their ordinary income level goes down, that is when we want to start doing more of the Roth conversion. Because personally, I do not like to see a Roth conversion that will yield a marginal tax rate of higher than 24%, meaning that when your ordinary income level is more than 24%, that's when the benefit of the Roth conversion kind of goes down.
Gotcha. Okay. So anytime you go over that limit, maybe look for another year to start doing it.
Right. You kind of want to look for the low ordinary income years to do your conversion.
Gotcha. Yeah, lots of planning. Sounds like planning is really the key to all of this.
Yes, it is.
Which I do think is a true story, because it's sounding to me, and correct me if I'm wrong, but tax is it's like a double-edged sword in the sense of that you want to look at this year currently because you'd like to not pay taxes this year, but you also want to prepare for the years to come. So you're setting yourself up for not a big tax burden in the future, inadvertently, if you will.
Yes, absolutely. That's definitely the purpose of planning is, you kind of look at, what the plan is down the road, not just looking at the current tax situation.
Gotcha. I guess on those 401ks, obviously Roth conversions is one option to try to help navigate the tax in the future. Do you guys have any other ideas of getting money out of those qualified accounts, the IRAs, the 401ks that are, we'll say, more tax advantaged than others? Because normally it comes out as income tax, which is fine because you've never paid taxes on it. But is there a better strategy?
Yeah, so what people do is that when they reach a certain age, they can think about the qualified charitable distributions, because once you hit a certain age, you're required to take RMDs, right? And
Right.
instead of doing that, some people go like, hey, look, I don't, I'm fairly financially comfortable right now that I don't really need those money, and I want to be a little bit more charitable. So what people sometimes do is, they go through the process of, making contributions to charities with their R&D money, right? So the tax benefit of that is, it's not includable in your taxable income. So in essence, you're meeting the requirement of taking the minimum distributions, but at the same time, that distribution you are donating to a qualified charity, therefore it is not taxable to you.
Gotcha. Which probably makes sense for a lot of, I'll say, retirees or business owners who sold their companies and don't have the deductions anymore, and now just kind of stuck with that standardized deduction, right? Because
Right.
I guess you'd have to give away quite a bit to go over that standardized deduction these days to
Yeah,
get that credit, right?
yeah, exactly. That's a perfect example, Brian. Because now, again, a lot of people say that. Well, then what is the downside of making these RMDs to a donate to a charity, right? You donate this money. It was like, well, the benefit is that it's not includable in your taxable income, but at the same time, you cannot double dip because some people ask the question. It's like, well, it's not including my income, but at the same time, I'm making donations to a qualified charity. Can I still deduct that on my tax return, right? And the answer is no, because you cannot double dip.
Gotcha. Makes sense. I get you. Well, all of that makes sense. I love all of these answers you've been able to give us. On to another topic. A lot of clients and a lot of people out there have Airbnbs or apartments or houses or buildings that they own. What's kind of the best way to take the income from the rentals that they're getting? Is it, because it comes as, do you suggest setting them up as LLCs, S Corps? I guess, kind of where do you get into that?
Yeah, sure. So from an income tax standpoint, as long as it's rental income, it makes no difference because again, you're still taking it in, you're still reporting as a rental income,
Okay.
right? As long as you don't try to convert a rental income into a management fee, right? Because a lot of Airbnb owners, they are also the promoter, right? So technically they say, hey, look, how about, I collect a fee for managing all these Airbnbs, and then the rental, and then that fee can offset rental income. It's like, well, guess what? Now you just effectively converted, rental income into, ordinary income that potentially can subject to self-employment tax as well. Depends on
Oh,
how
wow.
it's being set up, right? But then again, I think setting up an LLC is definitely a great idea from a liability standpoint because you want to separate some of the risk from these rental activities from you personally, because if anything goes wrong, this is probably more like, I always recommend people to talk to an attorney too from a risk management liability standpoint, because they want to set those up correctly. So then if anything goes wrong and you find yourself in a situation where you're not having adequate liability insurance, renters sue you, someone sue you, right? Then technically, you're not gonna open up all your net worth to the lawsuit, right? That's the importance of having LLC
Right.
set up.
Gotcha. But an LLC, a lot of people tell me, well, I have an LLC, so I'm good with tax. Like, does an LLC really affect your taxes that much, or is it's how it's taxed, right?
Yeah, so it doesn't help to save income tax, from a strategy standpoint. I think mostly for liability protection. Now,
Okay.
from a audit risk standpoint, then it depends on how some CPAs make recommendations, right? So me personally, if someone who owns multiple rental properties and there's a lot of activities, right? For the most part, I say, hey, look, definitely set up an LLC. But on top of that, depends on, how the LLC is being owned, right? So, if you say, hey, it's being jointly owned by, me and my wife, then you have the option to convert that, LLC into a partnership for tax reporting purposes. Now, the purpose of that is, well, a lot of people say, well, of course, CPA just want to do another tax return, right? I mean, sure, part of that is, could be true, right? But at the same time is, it helps to reduce audit risk because now you're separating, all these business activities from your personal tax return. So you kind of take that complex, voluminous reporting, away from your personal tax return. Therefore, the audit risk on your personal tax return, you know, will go down substantially. Now, again, it doesn't mean the IRS can't audit you; they can, but then that kind of creates another layer of hassle for the IRS because, again, if they want to audit you uh, on your personal return, then all you need to do is you show a K1, right? That where the activity is coming from, right? Now, again, if they say, hey, we want to audit that activity, then they have to get the business unit involved to audit the business, right? So,
Oh, interesting. Okay.
someone who's auditing your personal tax return, they won't just, hey, open up everything because,
Gotcha. Okay.
when it involves a business, they need to get the business unit involved.
Interesting. Okay. I did not know that. So that's very good to know. I love that knowledge. Um, on the ideas of owning things, and I know you deal with a lot of business owners, and kind of is more of your specialty as well. Um, in the sense, obviously, business owners get to the point where they'd like to sell, or they want to do something that can come with a lot of tax consequences because the cost
Sure.
basis is probably low in most scenarios, if you will. I know we've talked about planning, but how soon should they be talking to someone like you as far as, hey, how do we avoid this? What options do we have? What are the things that we could be looking at?
Sure. Well, thank you so much for asking that question, Brian, because this definitely become one of the more hot topics I say in the recent years because because of the market and everything. There's a lot of the mergers and acquisitions happening, right? And
Right.
I talk to clients who pretty much have a closed transaction already. They'll say, hey, I just recently sold my business. How what's my tax going to look like? I was like, well, my hope was that you would have talked to me before you sold the business because now it's a closed transaction, right? There's only so much that we can do for a closed transaction. So with that said, normally I recommend taxpayers, business owners to plan at least 2 to 5 years ahead, before they decide to
Oh,
sell
wow.
their business. Because again, from a tax strategy standpoint, sometimes it does take more than 1 or 2 years to restructure the business and make it more tax efficient when you sell the business.
Gotcha.
And
All right.
the tax consequences, is heavily involved with, structuring, and that takes time.
The, gotcha. So being able to set it up so it's in the right structure, so it's taxed efficiently, and being able to save on the whole transaction really makes sense. And it's a good probably 3 to 5 years out to make sure everything's kind of all in the row and ducks in a line, if you will.
Yeah, I mean, again, from a big picture standpoint, when someone sells a business, the goal is one, can we convert more of the ordinary income to capital gains? Because obviously, capital gains is taxed at a way lower rate, right? More favorable rate. And then two is there are also strategies to even defer the recognition of income.
Oh,
Depends on
interesting.
what the long-term goals are of the sellers. So, there's a lot of things that we can do to help to kind of minimize that, tax burden. And at the same time, we can even also further defer that tax burden that allows, sellers kind of, keep more money in their pocket, currently invest the money and yield a higher return.
Gotcha. All right. Well, that's fantastic. I love that. Um, that is perfect. Well, I guess I have a couple more questions, and I have some client questions that had asked me as well. In regards to extensions, right? I know a lot of people. I've heard it go both ways. Is that if you never extend, you won't be audited. If you extend, you won't be audited. Is there any like validation to that? Is it true, or is it just doesn't really matter? The government just wants their taxes whenever they get them.
Yeah, and again, another great question from you, Brian. I mean, from talking to, new clients who I have, right, and they always wonder, hey, why are you extending my return? I never had to extend my return. Will that increase my audit risk? I mean, I find that that's a very common misconception that people think, if they extend their tax return, that it will increase, the chances of being audited. And personally, and based on my past 18 plus years of experience, I find that not to be true. So, uh,
Okay.
because at the end of the day, filing an extension, it's a legal process that the IRS granted the taxpayers, because a lot of times, they need more time to accumulate information to file an accurate and complete tax return. So, what's really more important is that, the timely and accurate filing, right? And then also to avoid penalties, right? And then at the same time, it helped taxpayers to reduce stress, because knowing that they have more time, to gather information to file an accurate and complete tax return. Now, one thing I want to mention, in regard to filing an extension is that, some people think that by filing an extension, they also have more time to pay their taxes, and that's not true. Okay, so the extension is an extension of time for filing. It's not an extension of time to make payments.
Gotcha.
Okay? So the IRS will not, grant us an interest-free loan.
Gotcha. Well, that's fair. They do. You still get to use deductions too, though, or you get that extra time to fund retirement plans too if you're a business owner. Correct? Don't you get that extension time frame as well? Yes. For some other tax efficiencies, if you will?
Yeah, absolutely. So for business owners and the employer matching portion of the retirement plan, you do get, extended time to kind of, make that contribution, right? So technically, when we do year-end tax planning, we kind of factor all those in and kind of project what the tax liability going to look like for the business owner themselves, right? And
right.
That is the balance that we anticipate that they need to make. Means that we already factor in all the possible deductions and expenses that we could think of, we can anticipate, and that payment, that balance, if there's a balance due, they need to make that balance by April 15th.
Gotcha. Okay. No, that makes perfect sense. Well, in regards to filing your taxes, one of the big things I've heard about is obviously technology and thieves and identity theft obviously is on the rise, and something we always have to be cautious of these days. And I've even heard it, unfortunately, it has not happened to me, but I have heard of people having their taxes filed for them. And so when they actually go to file their taxes, they get a notice from the IRS saying, you already filed. Is that on the rise? Is that something that's new? And are there ways to maybe prevent that or help prevent that?
Yes, so I definitely see that more and more common in the recent years for some reason, and yes, there is a way to help to mitigate that, right? And the way is that you go to the IRS and apply for what's called an IP PIN. Okay, so it's like an identity theft protection PIN. Okay, with the IRS, and then the IRS issue a new PIN every single year. Okay, so for anyone who doesn't know your PIN, right? Just as if you have your own PIN to your debit card to go to the bank and make a withdrawal from the ATM machine, right? You got to enter your PIN, right? So that serves similar purpose on a tax return. So whether you file electronically, you file by paper, you have to enter that PIN, right? So if you don't have that PIN, the IRS will not accept your tax return.
Oh, fantastic. So is that something that individuals need to go on their own, or is that something they normally use with like their preparer or their CPA that they're using? What's the best practice?
Yeah, so, from a prevention standpoint, taxpayers can go on the IRS website to apply for a PIN on their own. I mean, it's very simple. I mean, it's very simple. The website they made is very straightforward. And people, people worry about that, they should go apply for that PIN. Now, again, for anyone who does not know about this process, right, and happen that, someone filed a fraudulent return on their behalf, once you notify the IRS will issue a PIN going forward.
Gotcha. Okay. That is perfect. Good to know. Well, my last couple questions actually came from clients that I had reached out to. I told them I was talking with you, and they were like, "Hey, can you ask these questions?" So one of them being, what are the pros and cons from a tax perspective of keeping your house or having your house in a trust? Are there any?
Yeah. So from an income tax standpoint, I don't see any benefit of putting your home in a trust. And normally when people put home in their trust, it's not for income tax purposes. Now, again, it may generate some benefit from an estate tax planning standpoint, because again, maybe some ultra high net worth individuals, has a big mansion, right? Has
Right.
high value, right? Then for estate tax planning purposes, they may want to, put it in an irrevocable trust. But most of the time, as part of, the conversation of taxes and planning and estate planning, etc., I almost always, bring up, the idea of that taxpayer should talk to an estate tax planning attorney if I know that they have an estate issue, right? Of the estate tax
Right.
issue, right? Now, for the ones who don't have an estate tax issue, it is still a good idea to talk to, a trust attorney, right? To set up, either a living trust, right? To avoid probate. That's the whole purpose.
Right. Okay. No, that makes perfect sense. I get you. Well, a lot of clients that I have, and this was where this came from, they want to help out their kids in
Mhm.
the sense of that they'd like to give them money, and sometimes they'd like to do it while they're alive instead of once they pass. Is there a good way to gift to the kids that doesn't raise flags and also doesn't create tax issues for either party?
Yeah, so when people try to, make gifts to their kids, for the most part, what I recommend them to do is, to maximize the annual exclusion. Okay, so if I mean, again, it doesn't matter if you kind of pay cash or put money into a 529 plan. It is important that they know what the annual exclusion amount is because that it's outside of your lifetime exclusion. So general from a gift tax standpoint, I think 2023 you get a lifetime exclusion about like 12.5 million or so, right?
Okay.
Now, again, on top of that, you also get the annual exclusion. And for 2023, the annual exclusion is $17,000 per person, per donee. Okay.
Okay.
So, for a taxpayer who got like 2 to 3 kids, right, they can, give up to $17,000 per kid in 2023 without having to report that on a gift tax return. Okay. Anything that's above that, I recommend, filing a gift tax return. Okay.
Gotcha.
Now,
And that's you said that's per taxpayer, right? So if you had like a husband and wife wanting to give to those three kids, technically they could probably give 34, right? So double up on the 17, one per
correct.
spouse.
That's correct. So it's per taxpayer per donee,
Okay.
right? So with that
Perfect.
said, yes, absolutely. If it's a husband and wife, they can definitely double that amount and take advantage of the exclusion. And sometimes I recommend taxpayers do one, need to kind of see how your kids are, right? If they're financially responsible, right? If anyone who have doubts about their kids, management skills with money, right? Then I also
Right.
always recommend them to put it in the trust for them, right? Or if
Gotcha.
put it in the 529 plans, to pay for the education.
Gotcha. No, that makes perfect sense. I love that. To that end, on the 529 plans, obviously sometimes things can happen or things can change, right? The kid
Right,
either maybe he gets a scholarship or maybe college just isn't for him
right.
or her, whatever it might be. Uh, what do you do with the residual 529 funds?
Okay,
What's the best way? Because
yeah,
you
that's a
put it
great
in
question.
and you got a normally a tax deduction depending on the state,
Right,
and it grows tax free. And if it's used for college, you get to take it out tax free.
right.
But now it's kind of stuck. Is it not?
Yeah, so I want to talk about the tax implications, right, of taking money from out of a 2529 plan. So, in general, I think from talking to some of my clients, it's a misconception that they're thinking, hey, if I take the money out to pay for non-qualified education expenses, not just that I have to pay tax on it, I also have to pay a penalty on the whole thing. Well, the truth of the matter is, you're not paying income tax and penalty on the whole thing. You're only paying income tax and penalty on the income portion of a 529 plan. So, when you take money out, you get a tax form reported to you, 1099-Q, and they kind of list out, what's the principal, what's the income portion. So, you're only paying tax and penalty on the income portion if you're using the money for non-qualified education expenses. Now,
Gotcha.
how to avoid income tax and penalty on the income portion of the 529 plan. One is, you're allowed to change beneficiary, right? So, what that means is if, your kid's done with school and you still have some money left, well, you can think about, change the beneficiary to yourself, right? Maybe, there's some, classes that you want to take to improve your skills. Okay, that could be, right? So, once you do that, then you can utilize that money to pay for qualified education expenses to avoid the tax and penalty. Now, there's also a few exceptions, to that, if the beneficiary dies or become disabled, if the beneficiary attends a U.S. military academy, receive tax-free grants and scholarships, and et cetera, then you can also avoid the tax and penalty.
Gotcha. Is there, with some of the new Secure Act that came out, can you roll it to an IRA at all? Your IRA, the
You know what?
additional funds?
Yeah, that's a great question, Brian. I mean, I haven't seen any of my clients done that yet, so I don't know the answer on top of my head. But I can
Okay.
definitely take a look. I mean, I heard about it, but I haven't personally read about it.
Okay. No worries though. I think it's new anyways. I just had
Yeah.
kind of heard it and was like, I wonder if that's true or not. Well, perfect. Well, here's my last question for you is obviously we're kind of in a remote area, if you will, or remote working area, I should say, right? Where a lot of people still work from home. For W-2 employees, I'm going to say this, going to make it specific.
Yep.
Do they get to write off anything for using their house for like working there, their computers, mortgage, things like that? Like, do they get any advantages if they work from home other than just it's really nice to be able to work from home?
After the tax law change of 2017, for W-2 employees who work from home, they're no longer allowed to take home office expenses because before, when you take that, it's subject to limitations. Now the TCJA of 2017 kind of got rid of that altogether.
Gotcha. That's unfortunate for W-2s. But if you're not a W-2 and you're an owner or an S corp or a 1099, you can, correct? There
Yeah, so
are.
correct. So technically, for with the exception of S corp, we have to do it a little differently because a lot. I mean, I actually seen a lot that some CPAs or tax preparer out there thinking that, hey, for S corp owners, they can still attach that home office expense form and take it, right? And I think there's literatures that came out from the IRS saying that if you are the owner of the S corp, you're considered an employee of your own company, right? So
Oh,
again,
yeah.
if you try to claim the home office expense the traditional way, then technically the IRS can't disallow that because of the tax law change. You're no longer allowed to take unreimbursed business related expenses for an employee.
Oh, wow. Okay. But I'm assuming there are ways to do it. It's just more about the
Yeah, so
planning phase,
yes,
right?
exactly. So normally for S corp owners, what I recommend is to reimburse for these business related expenses, in the form of a accountable plan that you're just as if you're reimbursing other employees for business related expenses. So it's through a form of reimbursement.
Perfect. Okay. No, that's fantastic. Well, excellent. Well, Henry, I can't thank you enough for your insight today. It's been very informative, and I've learned a lot, and I hope everyone else has as well. If people want to learn more about you or get in touch, what's the best way for them to get in touch with you?
Sure. Of course, they can call our firm, or can reach me by email as well, and I can provide you my email and contact information, Brian, for anyone who want to get in touch.
Perfect. Well, excellent. Well, again, really appreciate it, and thank everyone. Thank you for everyone for listening. Please like and subscribe as we bring you more ideas on how to simplify, navigate, elevate your financial life. Thanks again, Henry.
Thank you, Brian.